Principle is a fundamental concept in accounting that outlines the conditions under. Hi there, and welcome to our 10-minute video on accounting concepts. In this video, we'll be discussing some of the fundamental concepts that underpin the field of accounting, including the principles, assumptions, and constraints that help guide and shape accounting practice. So whether you're an accounting student, a small business owner, or just someone looking to better understand the language of finance, we hope you'll find this video both informative and engaging. Let's start with the principles of accounting. These are the general rules and guidelines that accountants follow when preparing financial statements and other financial reports. The four main principles of accounting are: 1. The revenue recognition principle. 2. The revenue recognition, which revenue should be recognized, or recorded, in a company's financial statements. 2. According to the principle, revenue should be recognized when it is earned, regardless of when payment is received. 2. This means that revenue is recorded when the goods or services have been delivered to the customer, and the customer is legally obligated to pay for them. 2. The principle also states that revenue should be recorded at its fair value, which is the amount of money the company expects to receive in exchange for the goods or services. 2. Adhering to the revenue recognition principle is essential for ensuring accurate financial reporting and transparency in a company's financial statements. 3. The matching principle is a fundamental concept in accounting that requires expenses to be matched with the revenue they help generate. This means that any cost incurred in earning revenue should be recorded in the same accounting period as the revenue. For example, if a company sells a product in January, but the cost of producing that product is not incurred until February, the cost of goods sold should be recorded in January when the revenue was earned. The matching principle helps to ensure that financial statements accurately reflect the performance of a business, and allows users to make informed decisions based on complete and relevant information. 1. The historical cost principle. The historical cost principle is a fundamental accounting concept that requires assets and liabilities to be recorded at their original cost. This means that the value of an asset or liability may not reflect its current market value, but rather the amount that was paid for it originally. The purpose of this principle is to provide a more accurate and objective measurement of a company's financial position. By recording assets and liabilities at their original cost, it helps to prevent overstatement of a company's financial performance or assets. However, it also means that changes in the market value of assets are not reflected in financial statements, which can sometimes lead to discrepancies between a company's book value and its true value. 1. The full disclosure principle. The full disclosure principle is an essential concept in accounting that requires all relevant and material information to be disclosed in financial statements and reports. This principle ensures that users of financial statements have access to all relevant information they need to make informed decisions. By including all relevant information, financial statements are more transparent and provide a more accurate representation of a company's financial health. This principle also helps prevent fraudulent activity by ensuring that all financial information is accurately and completely disclosed. In summary, the full disclosure principle is an integral part of accounting practice that promotes transparency, accuracy, and fairness in financial reporting. In addition to these principles, there are also several key assumptions and constraints that underpin accounting practice. Let's take a closer look at these now. The first assumption is the going concern assumption. This assumption states that a business will continue to operate indefinitely, unless there is evidence to the contrary. This means that assets are recorded at their original cost, rather than their market value, because the assumption is that the business will continue to use those assets for the foreseeable future. The second assumption is the monetary unit assumption. This assumption states that all transactions must be measured and recorded in a common monetary unit, such as dollars, pounds, or euros. This allows for consistency and comparability across financial statements and reports. The third assumption is the time period assumption. This assumption states that accounting information should be reported on a regular basis, such as quarterly or annually, so that users can track the financial performance of a business over time. Finally, there are several constraints that limit the scope of accounting practice. These include 1. Materiality dash. This constraint states that only information that is material, significant, should be included in financial statements and reports. This allows for greater clarity and focus in financial reporting. 1. Conservatism dash. This constraint requires that accountants be conservative in their estimates and judgments, so as to avoid overstating financial performance or assets. 1. Cost benefit dash. This constraint states that the cost of obtaining and presenting accounting information should be weighed against its potential benefits. This helps ensure that the cost of financial reporting is not excessive, and that the benefits of financial reporting outweigh the costs. So there you have it, a brief overview of some of the key concepts that underpin accounting practice. We hope you found this video informative and helpful. If you have any questions or comments, please feel free to leave them in the comments section below. And as always, thank you for watching. Accounting Concepts. Accounting Concepts.